When you're starting out, investing can seem really overwhelming. There's so much information, and it can be hard to know exactly where to begin. But don't worry, because today I'm going to share 10 smart investing tips that will help you get started on the right foot and set you up for success. Whether you're looking to build wealth for retirement, short-term goals, or just grow your savings, these tips will guide you toward making smart decisions with your money. Tip 1, start investing as early as possible. Time is one of your best friends when it comes to investing. The earlier that you start, the more time your money has to grow through compound interest, which is the process where your earnings generate more earnings. I can't stress this enough. The earlier that you start, the more powerful this effect becomes. I personally started investing about 8 years ago, and although it's been really incredible to watch my money grow over the years, I often regret not having started way earlier. I've learned that even if you can only invest a small amount right now, starting early gives your investments more time to grow. This can be the difference between a modest amount and a sizable nest egg by the time that you reach your financial goals. Tip number 2, know your why before you invest. Before you dive into investing, take a moment to think about why you're actually doing it. Are you investing for retirement, a short-term investment, or just for wealth building? When you have clear goals in mind, it's much easier to stay motivated and make the right investment choices. For example, if you're saving for retirement, you'll want to prioritize long-term, lower-risk investments. If you're investing for a short-term return, your strategy may be different. Knowing your why helps you stay focused and tailor your investments to fit your needs. Tip number 3, build an emergency fund first. Before you even think about investing, the first thing you should do is build an emergency fund. This fund acts as a safety net for unexpected expenses, like car repairs, medical bills, or a job loss. I recommend saving enough to cover a small to medium emergency before you start investing. Why? Because having this buffer allows you to handle life surprises without derailing your progress. Just for reference, the average unexpected emergency costs about $1,400. So depending on what your circumstances are, your starter emergency fund should be somewhere around $1,000 to $2,000 before you start investing. I also often get asked the question, should I invest my emergency fund? My answer to this one is no, because investments do tend to fluctuate over time, and the last thing that you want to happen is that you're dealing with an emergency and you have to dip into your investments during a down cycle. Going back to tip 1, you need to give your investments time to grow, and starting with this foundation is key to staying financially secure as you begin investing. Tip number 4, pay off high-interest debt. If you have high-interest debt, like credit card balances, it's a good idea to pay that off first before you start investing, because high-interest debt often has rates that can far outweigh any returns you'll get from your investments. As an example, the S&P 500 index has an average return of 10.11%, which is really good. However, if you're paying 29% on your credit card debt and investing at the same time, this is essentially the same as borrowing money at 29% to invest at 10%. It's like taking one step forward, then 3 steps back. I made sure that I had all of my high-interest debt paid off before I started investing, and I recommend that you do the same. Not only will it help out your potential for earnings, but paying off debt gives you more cash flow to put toward your investments. It will also help you reduce financial stress as well, which will be a huge game changer for your mental health. Once that high-interest debt is out of the way, you'll be in a much stronger position to build wealth. Tip number 5, start small. You don't need a lot of money to begin investing. In fact, you can really start with as little as $20, $50, or $100. The key is to start small and stay consistent. Over time, those small contributions will add up and the power of compound growth will do its thing. Taking a look at this quick example projection, if you invested only $20 per month for the next 30 years into the S&P 500 index at a return rate of 10%, you would end up with $41,934, of which $7,200 of that will be the amount that you contributed. Now, I know that $41,000 in 30 years might not seem like a lot, but it's a lot better than having nothing. One of the biggest mistakes beginners make is waiting until they have a large lump sum to invest. But the truth is, it's not about how much you invest, it's about making a habit of it and letting time do the heavy lifting. Tip number 6, learn the difference between stocks and funds. When you start investing, you'll encounter a lot of different investment terminology. 2 of the main ones that you will come across will be individual stocks and funds. It's important to understand the difference. Individual stocks can offer higher returns, but they come with higher risk. If the company performs well, your investment could skyrocket. But if the company struggles, you could lose a lot. On the other hand, funds, such as mutual funds, index funds, and exchange-traded funds, or ETFs, allow you to diversify your money across many different companies or assets. This reduces risk because you're not relying on the success of a single stock. For beginners, funds can be a safer and more balanced way to start investing. Think about it this way. If you put all of your eggs in one basket and that basket gets dropped, you will lose all of your eggs. If you put one egg in a bunch of different baskets and one basket drops, you still have a bunch of more baskets with eggs in them. This is what it's like to invest in either individual stocks or into funds. This brings me to tip number 7. Diversify your investments. Once again, don't put all of your eggs in one basket. Spread your money across different asset types, stocks, bonds, real estate, crypto, etc., to reduce risk. Diversification helps protect your investments if one area underperforms. For example, while stocks might have a strong year, bonds or real estate could offer stability during a market downturn. By diversifying, you're giving yourself a better chance to weather the ups and downs of the market. I personally like to be spread out amongst a few different types of investments, and then there are a few that I stay away from just because I'm either not really knowledgeable about them or because they aren't much interest to me. Everyone's investment portfolio will look different, as they should, but one thing you'll notice with a lot of investors is that they choose to diversify. Tip number 8, consider low-cost index funds. If you're looking for a really simple, beginner-friendly way to start investing, index funds are a great option. These funds track the performance of a market index like the S&P 500 and often have lower fees than actively managed funds. Over time, index funds have been shown to outperform many actively managed funds, and they offer a really broad diversification, making them an ideal choice for beginners looking to build wealth with really minimal effort. It is best to search out some popular index funds online and do your own research as to which funds will support your risk tolerance and financial goals. And never take a YouTuber's advice on which stocks and funds you should be investing in. Tip number 9, avoid trying to time the market. One of the most tempting but dangerous things you can do is try to time the market. Many beginners try to buy and sell based on short-term market movements, but no one can predict the market consistently. There was a period of time where I tried to do the whole timing the market thing with my investing. I was constantly researching the next hot stock trends, scouring Reddit, listening to investor calls, reading reports, checking my app 400 times a day. You want to know what I found? Well, for one, it was absolutely exhausting and anxiety-inducing. But also, my returns were really no better than just putting my money into more stable investments and letting it just do its thing. The truth is, investing is about long-term growth. Trying to time it can lead to poor decisions and unnecessary stress. Instead of focusing on short-term trends, stay invested and focus on your long-term goals. Patience really is the key. Tip number 10, understand the risks versus rewards. All investments carry some level of risk. However, higher risks often come with the potential for higher rewards. It's essential to understand your own risk tolerance, how much risk you're actually willing to take, and choose your investments according to that. If you're younger and feel like you might have a little bit more time on your side, then you might feel comfortable taking on more risk for the potential of higher returns. But if you're older and feel like you might have a little bit less time, then taking a more conservative approach would probably be the better way to go, and don't invest more than you can afford to lose. Remember, the key is to start early, stay consistent, and make more informed choices. By following these tips, you can help set yourself up for long-term financial success. Now, you and I both know that there are a lot more tips that can be given when it comes to investing, but I also know about information overwhelm as well. So next week, I'll continue this list and give you 10 more investing tips for beginners. So make sure that you subscribe so that you don't miss out on that video. Until then, check out this video here, where I share with you 10 of my own personal money rules that I use for my life. I can guarantee that they will inspire you to create some similar ones for your life as well. And I will see you next time.